Welcome back to the Wealth Amplifier podcast. I'm your host, Matt Liebman, and today we're diving into the markets with a special guest, Brian Levitt, who I've known Brian for about 15 years or so. Shout out to Brian Stein, who initially introduced us. Brian is the global market strategist at Invesco, co-host of the Greater Possibilities podcast, and a frequent voice on CNBC, Bloomberg, and major financial media. Without any further ado, Brian, welcome to the Wealth Amplifier podcast.
Yeah, thanks, Matt. It's great to be here. And I'm sitting here trying to do math in my head, figuring out maybe it's been longer than 15 years, but we have certainly known each other a very long time.
Well, I am a big fan of yours, and we all celebrate your success over here at Amplius.
So, thank you. Likewise.
Well, let's dive into some of your expertise. Let's start with the markets in general. Where are we now? Where are there any things you're keeping an eye on? Asset classes you like or don't like? Just your general overview right now.
Yeah, where we are now, it's a market that, well, I think if we take a step back, we remember that it was a pretty good setup for the year, for coming into the market, for the market coming into the year, good growth, inflation pretty stable. And so we got some policy uncertainty around Liberation Day. And so the markets went down. They've been recovering. They've actually gone up to a new high now, largely because some of these trade deals have been better than expected. Not better terms than we were a year ago, but better than expected. And we always say markets trade on better or worse, not good or bad. Now, on the other side, that economy's held up. It's been pretty resilient. Corporate earnings remain sound. So it's been a reasonably good backdrop for markets. It's been volatile, but I think if investors had just shut their eyes and woke up today with these markets up high single digits year to date, they'd be pretty pleased had they not known all that had transpired over the year.
Yes. And one thing that you and I have been talking about for a long time, and that is I've noticed in the market this year, is foreign markets are doing quite well and actually in many cases outperforming the U.S. What do you make of that? Is this the long overdue new reversion in global investing, or is it another head fake? What do you think?
Well, there's this idea of American exceptionalism. And in reality, if you think back around what American exceptionalism was, largely the U.S. stimulated the economy more out of the global financial crisis and out of COVID, which produced greater economic activity relative to the rest of the world. The other was a handful of really innovative tech businesses that were driving the markets. And so this year has called that into question a little bit. First with DeepSeek, right? People forget the DeepSeek announcement around what they've accomplished with AI, calling into question the U.S. dominance in that space. And then the second was, of course, the German commitment to stimulus as well as European Central Bank rate cuts. So you had a better policy environment outside of the United States for the first time in quite some time, and you have better valuations. So this is not to say that, things like the European economy are going to go gangbusters relative to the U.S. It's just expectations were incredibly high in the U.S. Exceptionalism, right? You can't get better expectations than exceptionalism. People had given up on the rest of the world, and in fact, you're now getting a policy response that's going to produce likely better outcomes outside of the United States. And you've got some good businesses there, as we've always known. So a little bit of the dollar off the boil is certainly a catalyst for that as well. So yeah, I think it's sustainable. I don't think we go from 100% U.S. equities to 0% U.S. equities. I think we increase some exposure to non-U.S. assets as a hedge against potential dollar weakness, and can also bring down the valuation of a portfolio.
Sure. Got it. And keeping with that theme, we've had this period of I'll call concentration, essentially U.S. better than foreign, as we just discussed for years now, stocks better than bonds, growth better than value, large better than small. So shifting to the U.S. for a moment, those areas of the U.S. market that have lagged in recent years, be it small caps, value stocks, et cetera, generally lagging those large cap growth stocks led by tech. Do you see any reversion there, or any case for increased diversification, or stick with what's been working well?
Well, you generally need a catalyst, Matt, as you know. And I actually thought coming into the year, when you were looking at a pretty strong nominal growth environment, that that should favor more value-oriented parts of the market. And you had a Federal Reserve that wanted to ease. That should favor smaller capitalization businesses that tend to have to roll paper. So the policy mix hurt that broadening phase. I mean, it's not been terrible. More than half of S&P 500 stocks are trading above their 200-day moving average, but it hasn't been an environment where small caps have shined or value stocks have shined. You need a catalyst, and what that could potentially be is a Fed that lowers rates, a reacceleration in the leading indicators of this economy. But you're in a patch right now where we're still waiting the effects of tariffs. And so that may be a little bit challenging, because what do tariffs do? They'll probably slow growth a bit and raise prices a bit.
Right.
So that's a little bit of a challenge for small caps. That's a little bit of a challenge. So right now, investors, again, are hiding out in quality. Hiding out in larger cap growth. That may persist for a bit here. There will be a day, and that'll be a day when we can lower rates and reaccelerate activity.
And sort of flipping to the other side of the ledger, the risk side, because things, as you mentioned, we had a bit of a hiccup in the markets around the Liberation Day in the spring. Markets have recovered nicely. But when you think about the risk environment right now, both in the short, intermediate, long term, what gives you concern? What risks are you most focused on?
Yeah, I'm always a person who doesn't want to fight the central bank. And, if someone were to come to me starting in this industry, tell me the first thing to know, the first thing I would tell them is, well, don't fight the central bank. And so right now, what you have is a market, and you have most strategists and economists believing that tariffs are not going to lead to broad-based inflation. Okay, and I'm of that view as well, but you had specifically asked me about risks. And so the risk we have is that we know that prices are going to rise in the near term. If prices aren't rising in the near term, that means corporate profitability is taking a hit. So it's not the worst thing if businesses can pass on some of those costs to consumers. The question is whether the market, i.e. inflation expectations in the bond market, start to view it as broad-based inflation, or if inflation expectations remain contained. To me, that's critical. If you start to see inflation expectations rise, the Federal Reserve either has to stay on hold in a weakening environment, or dare we even say raise rates. Again, that's not the base case, but that would be end of cycle type of stuff. And to me, that's the risk to this outlook.
Got it. And then, you had mentioned the Fed, mentioned rates, and which leads me a little bit towards politics and the idea of politics impacting one's portfolio or investments is not unique or new to the Donald Trump era. You and I started in this business probably around the same time in the sort of Clinton, W. Bush era, and people talked about politics and markets then, certainly with Obama, Trump, Biden, and now back to Trump again. But I can't hide that there are more political headlines now, and they come at us a little faster. How do you think about politics in your overall investment strategy? Do you tune out all noise? Is there some noise that matters? How do you think about that topic in general?
First thing I want investors to realize is that the markets have generally done well under most administrations. Okay, the only times you've had markets not perform well during an administration were Nixon and W. Bush, because they left office in crisis, right? The 73 inflation, and then the global financial crisis. Everybody else, the market has done just fine. So, Matt, the first thing I want to do is make sure investors aren't swinging their portfolios meaningfully because their preferred candidate didn't win. In fact, the first 6 months under Trump went fine. The first 6 months under Biden went fine, even better. The first 6 months under Trump too has gone fine, right? So, like that's the blanket statement. I mean, obviously, there's going to be things that policy could impact, largely around how money's going to be spent or how tax policy is going to be set. Now, that has to be done with the legislative branch as well. But given that there's single party rule right now, you've been able to see some pretty significant things being done. So there's going to be some winners and losers in, things like the One Big Beautiful Bill Act, these types of things. But the reality is, and you know it as well as I do, the markets price these things in pretty quickly. So when it seemed like you were going to get a One Big Beautiful Bill Act, you saw things like semiconductor manufacturers rally significantly. You saw airlines rally because they benefit from a further build out of air traffic control, communication, and infrastructure. So there was different parts of the market that did very well, and there were others like healthcare that didn't do as well. So the market priced it in pretty quick. It's not to say that there's not some tailwinds still to, manufacturing businesses in the U.S., industrial business in the U.S. So there's things that you can tweak. But I always go back to broadly, does it change the direction of the economy or what the Fed's going to do? And if for the most part it doesn't, then you largely stick with your plan. Maybe have your financial advisor find some opportunities beneath the hood as these things play out.
Well said and agreed. And shifting, further to the individual investor, but on more the behavioral side, which I know is a topic you've studied over the years. I've been reading the great new book from Barry Ritholtz this week, titled "How Not to Invest," and it's a lot of. I love it. It's really good anecdotes, good book in general, but in your experience over multiple decades of doing this, what are a couple common mistakes that you see investors make that they should look to guard against?
Well, it tends to come down to their inability to manage their emotions at the most inopportune times. And what ends up happening is they miss or potentially miss some of the best days in the market, which almost always come near the worst days in the market. And if you miss those best days in the market, it significantly impairs your returns over time. I'll give you two examples. One was March 24th, 2020. So I'm sure everybody could think back to what they were doing on March 24, 2020. I think my wife and I were washing grapes with Lysol on that day. But that was the day that you basically got a signal from the Fed and the Trump administration that they were going to provide substantial amount of support to the economy and the markets during COVID. And so the market, which had been down 35% in like 10 days, had freaked a lot of people out, significant amounts of money coming out of the market. And on that March 24th day, the stock market was up 9.4%. That's the third best day in the market since 1957. So or at least it was, you miss days like that, it significantly hurts your portfolio. Similarly, April 9th of this year. So 7 calendar days after Liberation Day, it looked like the market was starting to price maybe a recession from the tariffs or even a crisis from the tariffs. And then Trump said, okay, 90 days, 90-day pause. And the market went up 9.5% that day. So that's now the third best day since 1957. And again, and a lot of investors were bailing from markets after Liberation Day. So it's critical that we keep our wits and recognize that when bad things are happening, we have policy approaches that can help counteract the cycle. And those policy decisions usually come when it feels the worst. And that's when markets tend to rip higher, or at least historically have tended to rip higher. And it's a shame when people miss it.
Absolutely. We always say one of the most important things that we can do for clients, if possible, is help them avoid those one or two really bad emotionally driven mistakes.
Yes.
So as we get towards the final quarter, if you will, of the fourth quarter of the podcast here, wanted to give you just three topics, just sort of a rapid fire section, if you will, that are front of mind, getting a lot of headlines these days in our world. And just curious what you think of them. You can take it in any direction you want. But first one I'll go with, and you're not going to be shocked by any of these. Crypto. It's out there everywhere as you think of your day job and your personal life and so on. How much does the general broad topic of crypto, blockchain, wherever you want to take it, impact your thinking?
It doesn't impact my thinking a significant amount in terms of how I'm thinking about other asset classes. I do watch it with astonishment, as I think a lot of people have. When I think of it, does it belong in an investment portfolio? I want people to realize that the returns have been significant, obviously, but there's a substantial amount of volatility in it as well. So, what type of position should it be in a portfolio? I think I've read recently it's somewhere around 3 to 5% of global market capitalization, which is stunning. So, wow. I guess that's a reasonable starting point. My view on it is, again, be prepared for the volatility. What people also have to realize is that it's not a claim on anything and it doesn't pay you income. So I think it's potentially reasonable to own it given the size, given its percentage of global market cap, but just be mindful of, the downside potential of it. But I've been saying that since 10,000, Matt. So, maybe people shouldn't listen to me about
it. You and me both. I've always said I don't take a stand on it, but I've been watching, as you said, with some degree of astonishment and skepticism. But, it has gone higher and lasted longer than I would have expected. So,
and can we add FOMO to that? Skepticism and FOMO?
Sure. Yeah.
You and I would be having this conversation on a beach somewhere.
Right. If we had loaded up on that. Yeah, exactly. So speaking of hot trends, AI, I shouldn't say trend. AI is a big part of the economy and a growing part. But same question on AI. How does that impact you on a day-to-day basis?
Yeah, I think that's a big structural theme that we all need to be focused on. It seems the markets initially have really focused on the hyperscalers or, who provides the chips to these hyperscalers. And so you've seen the bidding up of the names that are either providing, the software or providing the chips that go into it. I'm not even sure that the market has begun to contemplate all of the downstream impacts of artificial intelligence. And I mean that from a positive. What everyone's going to do for a living is a different conversation than what it means to potential shareholders. And I think there's significant efficiencies coming to multiple sectors of the market, whether it's financial sector, whether it's the healthcare sector, many others. So the benefits haven't even really begun to accrue to the economy and the financial markets. I think we're in the very early innings of this.
And finally, on my let's say hot headline topic of the episode, closer to your and my world, although AI and crypto do touch our world as well, but private markets, private investments, it's seems to be all the rage in our business, which leads to a healthy dose of skepticism. Usually, when Wall Street gets hooked on something, it doesn't always end well for students of history out there. But recently, they've been talking about putting private equity, private credit investments like that in 401ks. Certainly, most firms are looking into more private offerings. What do you think about the growth of private investments in the high net worth or retail space? And best you can tell, what are some of the pitfalls and upsides of this?
Yeah, I always like the idea of expanding the opportunity set. And so expanding what tools you have in your toolkit when you're thinking about investing. And what I've always liked about private markets is that there's sizable opportunities within that space, in many instances larger than the public market. And I've, as long as people understand potential lockup periods or lack of access to their money over a certain period, that can help to take some of the emotions out of it, the emotion-driven investing that you and I were just talking about. The one thing to be mindful of, and you said, some skepticism starts to grow as Wall Street moves into it, is just to be mindful about the manager you're working with and the quality of investments, because the more money that finds its way into these types of things, then whether it's private credit deals or private equity, you could see the quality deteriorate in terms of what's being invested. So be mindful. But I come back to that first principle of I want to expand my opportunity set. I want to be able to look beyond just traditional assets to think about where else I could generate income or where else I could potentially generate returns.
Great. Well, thank you very much. As our regular listeners know, when we have outside guests, non-Amplius members on the podcast, we offer them the opportunity at the end of the podcast to amplify a charity, a nonprofit, a cause, something that resonates with them. So, Brian, what's on your mind in that area?
I'm going to go with the fight against Usher 1F, and Usher 1F might be may not be known to everyone, but one of my good friends' son was born with Usher 1F. It's a pretty rare Eastern European Ashkenazi disease where you're born deaf, you have challenges with your balance, and you gradually go blind. And so there's a lot of great work being done with gene editing and a lot of great work being done editing genes within certain animals to make them hear again, make them see again. And so the progress is really exciting. The challenge becomes the federal government stops providing support. There's just not a lot of people that are afflicted by it. So it's hard to call people to action about it, but it's a really great cause and something I hope people would consider.
Thanks, Brian, and thanks for calling our attention to that. And thanks, as always, for all your help. Great seeing you, as always. And listeners, if you enjoyed Brian's insights, as I did, please feel free to share this episode far and wide with friends and family. But again, just wanted to thank Brian for joining us.
Thank you, Matt. Really enjoyed it.